Okay, Sanborn, once again, you are still struggling to make the video to in landscape mode. It seems like I can only stream in portrait mode. So welcome back, everyone. Anyone that is here, that is attending the stream now as it's going live. So like we did last week, we're just going to start by covering other things before we attend to your questions. Okay, so I'm just checking. Right, it seems like everything is going as anticipated. Again, apologies for not being able to stream uh, in the landscape mode. Right, so let's start. So what I want us to talk about today is the difference between trading and investing, and also to touch a bit on how we do things as stock traders. So if you just joined for the first 30 minutes, I will do the talking. Then in the last 30 minutes, you can start sending in your questions. Once again, I want to say that I'm only able to stream in the portrait mode at the moment. I've tried to change it to landscape, but it's not allowing me, right? So now the difference between the stock trader and the stock investor, it's a very gray area. It's not easy to define. Sometimes as market participants, we find ourselves wasting time trying to define what the different is. But for each and every person that is in the stock market, it's important that you define what do you want to do for yourself, or what kind of a market participant are you. If you're an investor, you stick to being an investor. If you're a trader, you stick being a trader. The reason for that is because whatever happens in the market, you know exactly how to react based on what you are trying to achieve in the market, right? So if you join, just remember to subscribe if you haven't subscribed yet. If we say anything that adds value to you as a market participant, feel free to give us a thumbs up, meaning to like the video or whatever that we'll be saying at that particular time, right? So now when we speak about investing itself, the general definition of investing is when a person takes money, they buy more of the resources that will give them some money. In this case, we are talking about the stock market. We take our money, we buy shares in businesses. Those businesses, they provide goods and services. So we buy a piece of paper, share certificate that shows that we are part owners of those businesses. So if those businesses, they perform well, it's possible that the share price of those businesses will also do well, which will reflect, we'll see that the value of the paper that we are holding, it also goes up. Yeah, so that's what we do as investors. So there are so many ways we can decide which companies to invest in. The different type, or the common type of ways to assess companies. Some people, they use fundamental analysis. They go to the company financial statements. They look at the management, they look at the performance of the business, what the management says versus what the business at the end is doing. For example, if the management says that they are going to build a new plant for the business, then at some time the people are interested in knowing whether did the business build that plant. So that is all part of fundamental analysis. Fundamental analysis is not only used by stock investors, even traders, they do use a fundamental analysis. Then the other way of analyzing the market is called technical analysis. So with technical analysis, it's price and volume analysis, meaning that the stock market participant, they look at the price action of the share price, not the value of the business, the price action of the share price. Is the share price increasing? Is the share price decreasing? Is the share price moving sideways? Then they make a decision based on that. More often, technical analysis Some people, they once they start to see you using technical analysis, then they start to call you a trade, which is not always true all the time. Even investors, they do use a technical analysis because they want to be able to identify the trend in share price. If you want to look at the share price, you look at a technical analysis. If you want to look at the value of the business, you then use a fundamental analysis, right? So those are the two different ways that you can use to analyze the price of a security or the business. Okay, so now, like I said, when you invest, you put your money in the market, hoping that you are going to make more money in future. But as a stock trader, you also want to make money. It's just that the approach that you do it, it differs a bit. Like I said, investors, they look at the value of the business. Traders look at the share price of whatever stock that they are trading or the business. So to make money, the share price needs to go up, irrespective of whether you are an investor or you are a trader. If you buy a share at 100 Rand, if that share price goes to 150 Rand, it doesn't matter whether it takes days or it takes 3 years. Once the share price appreciates to 150 Rand and then you sell it, you will pocket the difference of 50 Rand, which is going to be your profit. So it doesn't matter whether you classify yourself as an investor or as a trader, but that is how you are going to make money. The other way of making money is if you buy a share of a company, that company does business, and then the business is profitable. Then the management decide to declare a dividend. It's the board that will declare a dividend. Not sure if the management requests that the board declares a dividend, but it is the board of directors that declare a dividend coming from the profits. So when you receive a dividend, that's another way of making money, right? So the way that I like to make money in the stock market, I want to invest or to buy companies that has share prices that are moving up so that I can benefit from capital gain and also pay capital gain tax when I sell that asset. But also, while I'm holding that company that has a share price that is moving up, if the business is profitable and then the board declares a dividend, then I receive a dividend. You see, that's the best of both worlds. You're making money from capital appreciation, but you're also making money from the dividends. So really it doesn't matter whether you call yourself an investor or you call yourself a trader, right? Now we spoke about the title of the video has some US stock market crash. Markets don't always go up. That is why when we speak about investing, right, sometimes there are people who still maybe don't know the concept of investing in the stock market. So now they ask, now I bought shares in this company, when am I going to make money? Making money in the stock market is not guaranteed, even though there are some companies that have been paying dividends for so many years. There are companies that are called dividend kings or dividend aristocrats. Some of those companies, they've paid dividend for so many years. Some of those companies, they increase the dividend that they pay each and every year. You see, but if, let's say, for example, a British American tobacco, it pays nice dividends most of the time. But if something were to happen, we don't know what is going to happen, but if something that nobody planned happened, then maybe it affects the business of British American tobacco. Then the business, if it's not profitable, it might not afford to pay people dividends or to declare dividends. Then that company stop paying dividend, depending on how the market is going to receive that information that British American Tobacco is now failing to pay a dividend. If they receive it negatively, they might start selling their shares. When then we will see the share price go down. You see, so now if the share price go down, depending on where you bought, if you bought at a higher price, then you're gonna start the value of your investment. You haven't lost money because you wouldn't have sold your British American Tobacco shares, but the value of your investment will drop. Let's say British American Tobacco cost 100 Rand and then you buy 10 shares. It means that you invested 1000 Rand. Then the share price drops to 50 Rand. Now the value of your investment is 50 Rand. You still have your British American Tobacco shares, but they are no longer worth 1000 Rand. Now they are worth 500 Rand. You see, that's what we mean when we say you're losing the value of your investment. And now, if you can no longer take that emotional pain of seeing the value of your investment dropping, and then you sell your British American tobacco shares at 50 rand, you're not going to get back 1,000 rand that you put in. You are going to get back 500 rand, meaning that you have now lost 500 rand in the market because the share price didn't increase. So now you should expect that, okay, some companies, the share price will go up. If it goes up, the value of your investment is also going to go up. But if the share price of the stocks that you buy drops, the value of investment is also going to drop. So in the market, anything can happen. You can make some money, you can lose some money. That is why we always talk about risk when you go to the market. The way that we define risk is a possibility of a loss, meaning that there's a possibility that you can lose a certain portion of your investment. The worst case scenario is that you lose all the money that you invested in a particular company. We've never seen anyone losing money from all the companies that they have invested. Remember, in the normal market, some companies will do well, some market won't do well. So those companies that don't do well, the value of your investment in those companies is going to decrease. But if there's a stock market crash, or if we are in a bear market, the difference between a stock market crash and a bear market is that the market can just crash, maybe lose a few points, maybe 1,000, 2,000 points over, let's say maybe over a week, then it recovers. But if we are in a bear market, that share price decline or all the companies struggling in the market is going to take a bit longer. It could be months, maybe a month, 2, 3 months, 6 months before the market stabilizes and then start to move up again. So during bear market, most companies they struggle. That is why now I want us to talk about the US markets. So we saw from November, the US market performed poorly. There were some companies that did much better compared to other companies. I had a position on Apple. That position was still profitable for quite some time. It just continued to hold up very well, but also I had positions in some energy stocks. But some tech companies, they were already struggling. The big tech companies like Amazon, Apple, they were still doing very much okay. Microsoft, Amazon, and Netflix were not doing that great. The share price was just moving sideways. So when you're in the market, you need to manage risk. So now, how do you manage risk? The way that I manage risk, I always use a stop loss because I can't predict that whether the share price is going to go up or down. Based on technical analysis, I can see that the path of least resistance for that particular share price is going up, but it's not guaranteed. If something happens, anything, then the share price can, instead of going up, it can start going down. So what I want to do, if the share price starts to move lower, I want to make sure that I reduce the amount of money that I lose in that particular position. Then I use a stop loss. A typical stop loss, it's a minus 10% share decline from where I bought the shares. If I buy the shares at 100 Rand per share, I can set a stop loss to be 90 Rand per share, meaning that if the share price drops to 90 Rand, then I cover that position, I take that 10 Rand loss, right? That's the way that I do risk management. Other people, they use risk management by the amount of money that they invest in a particular company. Let's say they want to buy Sasol shares, they're trading for 100 Rand per share. They just buy 10 shares, which is going to be 1,000 Rand from them, meaning that they are okay with losing 1,000 Rand if Sasol share drops to zero. You see? So, Mina, I keep my stop loss minus 10%. I can buy as many shares as I want, but I have a number. Typically, it's 500 Rand. So, it means that I will buy if it's 500 Rand, it means that I will buy about not 5 shares, I will buy 50 shares of Sasol so that when I lose 10 Rand per share, I can only lose 500 Rand per share. Don't focus on the maths, see the forest, don't see the tree. If the maths is incorrect, just get the idea behind the calculation, right? So those are the two ways that you can manage risk. You can just put the capital that you are willing to lose on a particular security. If you are okay losing 1,000 rand in a position, then you just invest 1,000 rand in a particular company. If it goes down with all that 1,000 rand. But the way that I do it, wherever I buy, I have a minus 10% stop loss. Like I said, if something costs 100 rand, my stop loss is at 90 rand. So that when the share price drops to 90 rand, that will be a 10% loss on the share price. Then I cover my position, I lose that minus 10%. Okay. But that is based on historical performance. Some of you have already watched the video where I showed how much money I made in the stock market. In that video, you will see that I do have losses and I try to contain my losses. An ideal scenario is to have a risk to reward of 1:3, but I had a loss that was 3 times higher than the normal risk that I normally take. Okay, so now how to hedge against a stock market crash? You can determine the amount of money that you are okay losing in your account. Like I said, some people they just use the total amount per position that they are okay losing. For me, I use a specific balance based on my total portfolio amount. Let's just make an example. I have a 10,000 rand portfolio size, and then I'm willing to lose 2% of my total portfolio on each position, meaning that I'm only willing to lose 200 rand per position. So depending on where I'm going to enter and where I'm going to exit if the stock market move against me. So the entry price minus the exit price is what determines my stop loss. In this case, if I'm buying at 100, my stop loss is at 90. So the difference is 10 rand. Then I take the 200 that I'm willing to lose. I divide it by 10. So that gives me about 20 shares, right? So then I go to the market, I buy 20 shares. If the share price drops to 90 rand, I sell all my 20 shares, then I get back the change, the 90% change that I will get from the market. That is how I manage risk, but that is per position, right? There's something that you call a table of risk of ruin. The table tells you how much you are going to make if you lose a certain portion of your account. For example, if you lose 10% of your total portfolio, you need to make about 11% to break even. If you lose 20% of your portfolio, you need to make 25% in order for you to break even. You see, so the larger the loss that you take, it means that you need to work much more for you to break even. I don't even want to think how much you need to make if you lose 50% of your capital in the market. In 2020, when we had the COVID scare, I sold some of my shares. I have held them for too long and then they started to drop in share price. Then I was forced to exit. I took a minus 20% loss around March 2020. Then I had to work to get about 25% just to break even. Imagine you lose 20%, now you trade the market, you make 25% profit, but that is not money that is going to grow in your account. That is just money that is going to take back your account back to where it started. Then fortunately, I made another additional 5%. So I ended the year 2020 with a positive 5%. But a lot of people, they made a lot of money. Tesla performed well. Facebook, most of the tech companies, including the ARK ETF by Kathy Wood, that people are laughing at these days, right? So you see, it's important to reduce the amount of money that you lose in the market, because if you now have to work to recover that amount, you really need to work. Sometimes you need to work twice as much just to break even. That is why I always say you must use a stop loss to reduce the loss, right? So now that I have defined my risk, that I don't want to lose more than 2% of my total portfolio per position. I know that if I lose 10%, I need to work about 11%, which is not that difficult. But to be realistic, let's say I'm okay with losing 50% to take a 15% drawdown. It's still big, but it's less than the 20%, right? So if I lose about 15% of my capital in the market, I need to return about 18% to break even. So now I know that, okay, 14%, let's say 14% instead of 15. It means that now I need to invest into 7 companies. Remember, each company, it's 2% risk. So 2 times 7, that gives me 14. So if I have 7 companies and all companies, they go against me, then I lose that 14%. Then I will stop trading a bit, reflect to check if the market is meeting the conditions of the strategy that I'm using. If the market does not meet the conditions, it means I need to stop trading, because the more I trade, the more money I'm going to lose. And if I lose more money, it means I need to work even more so that I can just break even. Remember, in the market, it's important that you protect your capital. We said last week, one of the reasons why people are scammed by the scammers. The market won't scam you. The market goes up and down. It does not know you, it does not know your name, it does not know your gender. So the market is one of the most fair places you can play this game of trading or investing. But scammers, the reason why people lose their money to scammers is because they think of how much money they can make. They don't think about how much money they can lose. If you know that per position you can lose 1,000 rand, then you start to pay attention. You start to think about the trades that you want to make. But if you think about the money that you can make, if you say, for example, you're going to make 10,000 per position, then you don't even think about the amount of money that you're going to invest there. That is why it's easy when somebody say, put in 100,000, you will get. Okay, somebody, let's use a realistic example. On TikTok, there are people who present themselves as if they are coming from Luno. They say people should give them money, then they can make a couple of thousand rands after a while, whether it's 48 hours or after a week. If somebody says, give me 1,000 rand, you will get 8,000 or 9,000 at the end of the week. It means that that person is promising to grow your money 8 or 9 times, right? Now, you don't think about the 1,000 rand that you might lose if that person scams you. You are thinking about the 9,000 that you are going to gain. I don't know what happens in your mind. Why do you think it's guaranteed that you are going to make money? Remember at the beginning of the video, I said that the only way for you to make money in the market is if the share price increases. So whether you are trading Nasdaq, Forex, or what else? I'm just trying to think. Indices. Again, the share, or even crypto. In this case, we're talking about loan crypto. The value or the share price of that crypto needs to go up for you to make money. So if the person, they say that they're guaranteeing you that they're going to give you 9,000 at the end of the week, what is it that they'll be trading that is going to go up? We saw last week all the cryptocurrencies and tokens, they just fell. Some of them, they fell by over 30%. So where is this person going to get that 9,000 that they're supposed to give you at the end of the week? Now you see, that is how you are going to get scammed. So you really need to have realistic expectations, understand how the stock market works. Number one, you need to know whether you are a trader or an investor. Then you need to use an approach. You can use fundamental analysis or you can use technical analysis. Then you need to manage risk. You need to know when you're going to exit if the share price drops. Also, you need to know when to exit if the share price go up and you are into profit. Then another thing that is worth touching. Remember, we can make money if the share price go up, meaning that it's a capital gain. We can also make money when the companies that we buy, they pay us dividends, right? Which can sort of create a dividend income. So as a market participant, you need to decide, are you investing for capital appreciation or are you investing for dividend income? For capital appreciation, you want to invest in something that has a share price that is moving up. For dividend income investing, you want to invest in a security that will pay you dividends. It doesn't matter. Some companies in South Africa, they pay dividends every 6 months. So every 6 months, you need that cash to keep on coming into your account, and make sure that those companies, they're still going to pay you those dividends as long as you remain invested. Some people, they try to split between growth, capital appreciation, and also dividend income. If you've been following social media recently with the stocks in the US crashing, some people, they started to talk about value, that now the capital is moving from growth stock to value stocks. Basically, what it means is that people are no longer investing in those speculative companies that don't even generate profit, but they have a potential to grow in the future. The share price is going up, people are riding that hype. But there are some of those old companies like Coca-Cola that have always paid dividends. Pepsi company, Mondelez, Procter and Gamble, you see. So you need to understand that. And then there's nothing that can stop you from investing both in growth and dividend paying stocks, right? So now we are 25 minutes into this live session. From 30 minutes onwards, I will allow you to start sending in your questions. Any questions regarding the stock market, then I will be able to answer all your questions. So now, like I said, the video that we made today, I'm going to leave the link in the description, where I was talking about building a defensive portfolio. In that video, I speak about how to select companies that can pay you dividends, even if those companies that struggle, for example, or value companies. So what happens is that okay, now the questions are disturbing me. That is why I said 30 minutes, not now, right? So we want to beat inflation, first of all. So we need to invest in companies that have a dividend yield that is greater than the inflation rate of your country. Here in South Africa, the current inflation, I think it was about 5.9 for December. The Reserve Bank just released that data. So now we're going to look for companies that have a dividend yield that is greater than 6%. They are not so easy to find. Sometimes we have to tolerate companies that have a dividend yield that is lower than that, because just because a company does not have a high dividend yield, it doesn't mean that now you have to miss that company. Some companies are still good. I mean, I was looking for companies to buy in the US. When I look at the dividend yield, most of those companies have a dividend yield that is less than 4%. But okay, now the inflation at US, it's about 5%. But what was lower in the US was the interest rate. I don't think that the interest rate in the US is now above 3%. Here in South Africa, the prime lending rate is 7%, inflation is 5.9%. So if you invest in a company that can give you a dividend yield of 8%, you are in a much better place. But also do keep in mind that the share price should at least go up in order for you to realize that capital. Then another way to hedge, I don't like investing in bond that much, because trading stocks, especially swing trading, I can make 30, 20, 50% in those trades. So I don't see the need to invest in a bond just because a bond is low risk and it has a guaranteed interest rate or a yield. If the yield is 5%, I know I can do better in the stock market, assuming that I don't lose more than 5% of my capital. So other people will go back to asset allocation to decide that a certain portion of their investment must be in equities, meaning individual stocks. Some of the portion should be in like property companies, because property companies, we look at the rental income, which is more like a fixed income asset. Then also some people will then look at into bonds, and then with the bonds, then they try to construct a portfolio that will perform much better. Or some people even include metals like Ray Dalio. He has what he called an all-weather portfolio. But before you create that portfolio, do keep in mind, where are you in life? Remember, sometimes we say some people have arrived. So you need to look at your life and decide whether are you still coming or you have arrived. If you are still coming, you want to make sure that you make the best return on your investment as possible versus someone who has arrived. Let me make an example. Ray Dalio is a billionaire. Let's just say he's worth 2 billion US dollars. He could be worth less or more than that, but let's just use 2 billion as an example. The all-weather portfolio is quoted to return 8% per annum. That means that Ray Dalio is able to generate 160 million US dollars from his net worth. Now you see, when as a South African, how much you're generating per year? If you have 100,000 and you return 8%, that is 8,000 rand. What are you going to do with 8,000 rand? That is not enough to cover a family of 4 household in the city. You see, so for you, it's important that you return more than 8%. Don't just read those books that quote those percentages and then Mr. Bodiba, this video is going to be live. It's always going to be there. You can check the first 30 minutes that you missed. Yeah. So as I was saying, it's important for you to understand. If you have 100 rand, your 8% is 8 rand. 1,000 rand, 8 rand. 10,000 rand, 800 rand. 100,000, it's 8,000 rand. If you have 1 million rand portfolio and you return 8%, that's 80,000, right? What can you do with 80,000 in a year? We understand the dynamics of the country, so we understand that there are people that earn less than 50,000 per annum. So for someone that earns less than 50,000, 80,000, it's a good return. But we just need to be honest and realistic. If you have a 1 million rand, it's not worth it to bring back 8,000. You might as well participate in something that can return more than 8%. So yeah, don't just say, oh, but the stock market can return this much. That is good enough for you to set realistic expectations. But your job as a trader, as a DIY trader, is to beat the market, beat the benchmark, beat inflation. Because if you focus more on beating the benchmark, if the benchmark is down minus 10% and you are down minus 5%, you still lost money. If the inflation is 5%, it means you basically lost 10%. So yes, it's nice to beat index, but it's also nice to beat the inflation because you preserve the buying power of your capital. Understanding this YouTube channel, we speak more about trading, but we also understand financial literacy. We understand the importance of investing, having an emergency fund, beating the inflation, ensuring that we're investing in assets that can give us inflation beating returns, right? So now we are past the 30-minute mark. You can now start bringing your questions. Any questions regarding the stock market? If I can answer it, I will answer it. If it's beyond my understanding of the stock market, I will say that it's beyond my understanding of the stock market. So as I wait for your questions, I will just keep on talking about other things, especially what happened in the market this past week. So basically what happened in the stock market this past week, but before we start, let's have some coffee. Right? So this week, as I was scanning through the chart, I had a buy signal from Kumba Iron Ore, Anglo Gold Ashanti. I don't remember if I had a buy signal from any of the Anglo companies. Then I thought that, okay, Kumba Iron Ore is an iron ore, mine. And then Anglo Gold Ashanti, it has some gold in it, but it's not just iron ore or gold for these companies. Then I realized that, okay, if I split my capital, I buy Kumba and I use my other capital to buy Anglo Gold Ashanti, I'm just spreading my investment. I'm getting two businesses that operate in two different mine sections. So what I did, the more I dig, obviously, if you go to the Kumba Iron Ore website, it takes you to Anglo-American website. Well, Anglo Gold Ashanti has its own standalone website. Then I went to the Anglo-American PLC. It's a global website, so it's angloamerican.com. Even though they have a section of angloamerican.co.za, which talks about the South African operations. Then I realized that, okay, Kumba Iron Ore and Anglo Gold Ashanti and other companies, they are part of the Anglo Group. I looked at the chart of Anglo American PLC. I saw that the share price was breaking above a resistance level. Then I decided to buy Anglo American PLC instead of buying Kumba Iron Ore separately and also buying Anglo Gold Ashanti. So that is how sometimes I think as a market participant, if I get a buy signal from, let's say, Steinhoff and Pepco, I know that Steinhoff owns 80% of Pepco, right? Pepco already has its own subsidiaries, different companies. There's Pep, Ackermans, Hi-Fi Corporation, and many other stores. But under Steinhoff, it's all the companies from Pepco and some furniture companies. Then instead of splitting my cash between those two companies, I might decide to buy a Steinhoff, except that I don't like a Steinhoff that much, so I decide to buy Pepco, for example, right? Before I continue, all right, I'm based in Pretoria East. Yeah, I'm based in Pretoria East. So that is how you need to think as an investor or as a trader. See where you can get the best of both worlds. So with buying Anglo American PLC, now I no longer just have an exposure to iron ore or gold. Anglo American PLC is also involved in diamonds. They're also involved in a metallurgical coal. So we made a video on that, the dividend portfolio update. We speak about the trade that I made there. I had a position on Redefine Properties, which is a real estate investment trust. I said in the past there that that company had a dividend yield of about 13%. In December, they paid a distribution of 60 cents because I had a reasonable amount of shares. I got around about 1,400 in dividends from Redefine, but now the share price is starting to decline. I don't know how long it's going, how low it's going to go. So I don't want to ride that downward movement. So I decided to exit my position on Redefine. I'm still bullish in the property sector. That is why on my tax-free savings account, I have the property ETFs because I'm bullish on the property sector. Maybe what I'm going to do, I'm going to look at other property stocks to see which have a share price that is trending up. You see, when it comes to loving a specific company, the company that I like in property is Growth Point. But I try not to invest in companies that I love unless they perform better because I don't want to create that bias. Now you buy a company because you love it, but the share price is not performing as you want it to perform. That creates a problem for you as an investor or as a trader because now you're just going to be sitting in that position. That position is losing your money, but you love that company. We saw that some people, they made a lot of money investing in ARC Innovation ETF. So ARC, it's a US based fund managers owned or managed by Kathy Wood. So since people made a lot of money in 2020 and also at the beginning of 2021, then they start to have emotional attachment to their investment, especially the investments that they've made them a lot of money. When the share prices start to decline, instead of exiting their position to lock in those profit, people they keep on adding, buying more. There is a concept of buying a dip, but when you buy a dip, you don't buy a dip while it's dipping, right? Well, some people then they start to ask, how do I know that the dip has stopped dipping? Remember, as the share price it continues to move down, it means that the dip is still dipping. At some point, the price has to bottom. The share price fall, then it starts to move sideways. Then when it starts to move sideways, then we can start to say that okay, the dip has stopped dipping. We're looking for consolidation. The price bounce up and down between the support and resistance. What we are looking for at that particular time, we're looking for the price to break above the resistance level. Once the price break above the resistance level, if we loved a company, then we start buying that company. We don't, if the share price consolidate and then break lower, we don't buy the company because it means that the dip is not done dipping, it still continues to dip. So next time you want to buy a dip, just look at the chart, see whether the dip is done dipping before you spend more money. Losing money in the market is possible, but the last thing that you want to do is to add more money into a losing position. There you are just playing a losing game. There is no diplomatic way to put it. You might think in your mind that if the share price recovers, you're going to make a lot of money. Remember, in the stock market, there are so many companies that never recovered. They started as nice companies, share price was high, then the share price started to fall. People kept on buying, but the share price it just kept on falling. The value of the investment of those people it kept on declining. So you don't want to keep on throwing good money after bad. If the stock market crashes and all the share prices are buying, I'm not saying it's not a smart move to buy the companies that you love at a lower price. I'm just saying, let them fall a bit. Once they've stopped falling and they show you signs that now they are recovering, in technical analysis, we see a series of higher highs and higher lows, meaning that if the recent low was 90 rand per share, the share price can attempt to go up and then it recovers. I mean, then it starts to fall again. If it falls to 95 rather than 90 rand, then that new low is higher than the previous low, and then it can try again to rally, maybe reach 105, then pull back 200 rand per share. Now that shows you, or that tells you that now the trend has changed. Then you can start buying, accumulating shares in the companies that you love once again. But as the share price is still falling, it is not wise. We don't do it on our own account. We will never recommend that you do that in your account. Okay, I see someone, Zoliswa, says she has a relationship with Hewlett and it's dipping. You want to stop buying. Yes, do stop buying. In terms of breaking above, I mean, I've been looking at the chart. There was a time in 2021 where I tried to buy Hewlett. Not sure if I made a video, but I know that at some point I bought Hewlett. That trade just failed spectacularly. It just boom went down. So I exited with a small loss. Since then, I haven't been holding Tongat. Same with EOH. EOH was also promising that it was going to recover. I bought some shares, then it started to go down a bit. So don't buy, don't add more money into a company that is losing you money. I understand. I mean, I don't know, maybe people, they want to have million shares in companies. Yeah, if the company is moving up, it's nice to have a million shares because it means that you're going to get more dividends. But if the share price is falling, don't keep on buying that company because you want to have more shares. It's like collecting rocks. No matter how many rocks you collect, it's just rocks, they are useless. But if you collect more diamonds, then you're going to get more value from your diamonds. So at this moment, unfortunately, I can't share the screen with you. Remember, I'm using my phone for this live and now I can't share my screen, but I can look at the price of Tongat here on the laptop in front of me. One day I will have a better laptop that I can be able to stream and share the screen and whatnot. So at this moment, the share price of Tongat is around 4.95 cents. I'm just going to zoom in a bit so that I see where we can expect when we're going to say that, okay, so if I'm looking at this, I normally use the 200-day exponential moving average to determine if I can buy a company or I cannot buy a company. So when I'm looking at this, so as long as Tongat is trading below 7 rand 10 cent, I'm not touching it because it means that it will still be trading below the 200-day exponential moving average on the daily time frame if you know how to read the chart. So just keep in mind that as long as it's below 7 rand 10 cent, 7 rand 10 cent, I'm not touching it. So now they spoke about the rights offer. Well, the rights offer is tricky. The word on the street is that there was some accounting fraud that happened. Some members of management benefited from that accounting fraud. So now, why would I give a company more money? What are they going to do with that money? Who's going to benefit there? You see, I'm not saying that I don't participate in rights offers. I need to understand where the money is going to be used. When I was starting to invest in Curo, that was around 2015, 2016. Curo was a relatively small company at that time. And there was just those expansion, people building more and more complexes. Curo was trying to build more and more schools in those complexes. So now you see, well, I'm not an accountant. I don't know what is operating expenditure or capex, opex. I don't know those kinds of things. But when Curo was asking investors to give them money, they were using that money to build more schools. So at the back of my mind, I thought that, okay, if Curo is able to build more schools, they will attract more learners, then they will be able to generate more revenue or income from that private schooling activity, then they can make money. So it's different. Or you own a company, the share price is not falling, it's flat, then the company says, okay, we're sitting at 2 billion rand debt. We are raising funds to pay off 1 billion debt. If I understand where that debt came from and how that if they pay off, or how that money was used when they got into that debt, if they were going to use that money for something good, then I can participate in a rights offer, and then the company can pay off that portion of debt, which whenever they pay debt, the balance sheet, it improves. Remember, when you look at the balance sheet, we look at the asset and liabilities. We want to invest in companies that has few liabilities and more asset. Remember, asset, it's owner's equity plus liabilities. That is just some accounting stuff, but I always look at the current asset, current liabilities. The assets and liabilities are always going to be equal in the balance sheet. That is why they call it a balance sheet. But in terms of current asset and current liabilities, they don't have to be equal. I want the current asset to be greater than the current liabilities. So the rights offer that Hewlett wants to do, I'm not happy with it. Fortunately for me, I'm not a shareholder of Hewlett. So it's none of my business why they are raising money. I see that they made an announcement that some shareholders, 20% of the shareholders were against that right offer. The 80%, I guess, approved it, but the shareholders that lost that vote, I think they are planning to approach the court so that they can stop that right offer. And something to keep in mind, well, the reason I don't do fundamental analysis is not because I don't have an accounting background, so it's above my pay grade. Technical analysis just works well for me. But another thing is because I know that it's less likely that I'm going to buy a lot of shares in a company. I know how much money I have. The shares that I'm buying in a company are just marginal, they are insignificant. So now imagine now you have to vote against those people that have millions of shares. They can just pass any resolution that they have. That is why I consider myself a speculator, because I know that I can't control the business. You see the difference between Warren Buffett and everybody else that tries to be Warren Buffett, the people that live off Warren Buffett quotes, is that Warren Buffett, if he buys shares, right, he buys shares via a Berkshire Hathaway debt holding company. If you buy shares in a company, most likely Berkshire is going to get a seat in the board of directors. Once you sit in the board of directors, then you have an influence. Okay, you are welcome, Zuliso. So once you have a seat in the board of directors, you can now sit there in the board of the company, make decisions. If you feel like a certain business is not performing well within the company, maybe you can close that division or you can improve it. But if I'm buying shares, there's nothing that I can do. If the board of directors they decide to increase their director fees, there's nothing I can do. If they decide not to declare dividend, there's nothing I can do. So I'm not saying that you shouldn't do your due diligence. You should always do it at all times so that whenever you buy a company, you are satisfied with the decision that you are making. But what is equally important is that you have an exit plan. If you buy Tongat, let's say you buy it at 10 rand per share, some people they say that they're going to hold on forever. They don't care whether the share price go up or down. Let's be realistic. When the share price drops, it starts to affect you emotionally. Once it affects you emotionally, it doesn't matter that the day you bought those shares, you had just read Warren Buffett and you thought that, okay, I'm still young, I'm going to hold on to these shares forever. It's painful to lose money in the market just to see the value of your investment drops. It's even much more painful to exit that position because now you are forced to exit that position because the share price has just dropped drastically. That is why I reduce my losses to about minus 10% share decline, because I can emotionally handle a minus 10% on that particular position. Remember, we want to protect that money, and also at the same time, we want to protect our mental health. If we start to lose a lot of money, then we are not thinking straight. If we're not thinking straight, now it's going to be difficult for us to trade the stock market because now we are afraid. Don't lose so much money in the market that you start to become afraid of the market. Remember, you are in the market to make money. Once you are afraid of the stock market, how are you going to make money? So it's important that you preserve capital loss, but also you ensure that you don't suffer mental well, not mental loss. You're not going to lose your mind in the market, but just you keep yourself still in that sanity. You can think straight, you can identify other opportunities, and life goes on. Like I said in that video, the recent video, is that I had position on Redefine. The share price started to go lower. I exited Redefine. I took my loss. Then I moved that capital I invested in Anglo American. There's no guarantee that Anglo American is going to perform better. Even before I sold my Redefine shares, I had shares on Nampak. Nampak is still doing okay, but it's not at that time the setup on process. I never had a position on process or Naspas, so I sold some of my shares from Nampak and then I took a position on a process. If process does not work the way that I anticipated it, I will lose a bit of money. It will suck, especially if a Nampak end up performing much better than a process. But a portion of the Nampak man was invested on Sibanye Stillwater. The position on Sibanye Stillwater is performing well. I know that I'm up. I have a bit of a profit there on the Sibanye Stillwater trade compared to the Nampak. So you really need to think about your investment. How are you going to make money from them? If you don't make money, how are you going to reduce the loss there, right? So I see that we have about 9 people watching live. Do those people have questions? If you have questions, just keep those questions coming. I will answer those questions, right? On TikTok, I made a video to ask people, why do they open Easy Equities account, figure the account, deposit money, and then not invest? Some people, they said they don't know where to start. It's understandable. The best way before you even invest, it's important that you understand the concept of investing. You can go to Easy Equities Academy. You can read more how the platform works, what is investing, when do you get dividends, the date that you have to keep in mind when you are going to receive dividends. So Easy Equities Academy is the best free learning platform for beginner investors. But also Easy Equities does have a YouTube channel. You can watch the videos on the YouTube. They cover a lot of things. Sometimes they are analysis, they are doing stock analysis. Sometimes they speak about ETFs. Sometimes they just talk about the platforms, the new changes in the platforms, how you can use the platform either on the website, on the app. So what I'm trying to say, if you want to invest, especially if you use Easy Equities, you can learn a lot more on the Easy Equities website, and also you can learn on the YouTube channel. The good thing about the information is that the information is universal. Whether you read the information on Easy Equities or IG or eToro, it's the same thing. Shares are going to be the same thing. Another website that explains some of the concepts nicely is investopedia.com. So if you go to Investopedia, you want to understand what is return on equity. They will have an article explaining what is return on equity. They might even have a video which will make it easy to understand return on equity, return on investment, asset and liabilities, positive net working capital. So those are the places where you can learn. Obviously, you can still learn in our YouTube channel, Trend Trader YouTube channel. When we started this channel, we were focusing more on technical analysis and stock trading, but we saw as the channel grows, we got questions from different people. We saw that, okay, sometimes we also need to cover the basics, because the reason we started this channel, there are a lot of people that are investing, no matter how they are investing, but there were not a lot of stock traders. So we wanted to cater for stock traders, especially the people that use technical analysis. So we wanted to just make it easy for people to understand technical analysis, and we are fortunate that some people responded positively. The YouTube channel has close to 2,000 subscribers, If you haven't subscribed, please consider subscribing and do watch some of those videos. If you find value, give us the videos a like, because that helps the YouTube algorithm for people to reach this channel easily, right? So we wanted to cater for the stock traders, the technical analysis people. We covered stocks, we covered indices, we covered cryptocurrencies. What we haven't covered is Forex. I don't trade Forex a lot. I mean, as a person, you need to choose your specialty. Don't be involved in everything. Sometimes you see people, they want to talk about crypto. You can tell that this person does not understand crypto. There is no need for you to be invested everywhere. If you have 100,000, you return 30%, you close the year with 130,000. It doesn't matter whether that money came from reselling stuff, operating a taxi, selling a makota. At the end of the year, you just have that extra 30,000. So there's no need to spread yourself across different platforms. Pick a platform where you have strength. That is why I stopped trading Forex, because I saw that I suck at trading Forex. There are people who are doing very well with Forex. I'm happy for them, and I'm also sure that they are happy about their performance. For me, it was easy to just trade shares. I know that shares are more volatile compared to Forex, but I'm at a point where I can handle that volatility, I can handle risk. So I'm happy to be a stock trader. That is why I don't really bother myself much about the other things that I can't trade. So now, as a person, you should focus on where you have strength. Some people are good business people. You like, on Facebook, I'm friends with a lot of farmers. You can't tell farmers about Bitcoin. They just don't care, because they know that okay, I will answer the question now, Tobeko. So the farmers, they know that they can do farming, produce, sell their product, and then generate money from it. So if you come with your Forex or Bitcoin, they are not interested. Right, let's see the question. Did I find that trend analysis was not applicable to Forex trading? No, technical analysis or trend analysis, it is applicable to Forex. It's the time frame that differs a lot. With the way that I use technical analysis or trend following, I use it on a daily time frame. With Forex, remember I said shares are more volatile compared to Forex. So you look at the US dollar euro exchange rate, euro USD, it just fluctuates maybe between $1 and $1.20. So you're not going to make a lot of money there. There are not plenty of opportunities for the exchange rate to move from $1 to $1.20, or from $1.20 back to $1. So what people do, even if it's just a 2 cent move, people use leverage so that the size of that movement, it becomes big. They buy a large volume. But also the currency pairs, some of them are trading in the range. The euro USD, GBP USD sort of is trading in a fixed range. But if you look at USD Japanese yen or euro Japanese yen, that market tend to trade. So at the time, I wasn't that skillful in terms of trend following. So I may have applied trend following on incorrect Forex pairs. But before I quit Forex, I did trade support and resistance a bit. So there I was a bit profitable compared to when I was using moving averages. So that's when I realized that some markets are trending, some markets are trading in a range. Same thing with shares. If you use trend following in a ranging market, you're not going to make money, because you're just going to be stopped a lot of time. You want to find those markets that are trending. Then again, another thing, it's the time frame. When I'm trading stocks or indices or even ETFs, I use the daily time frame or the weekly time frame to see the trend. With Forex, if you use the daily time frame, you're not going to make money, because very few currency pairs are going to break above the previous day, a low or high of the day. Normally, they trade within that range. So now you have to trade at lower time frames. Some Forex traders, they trade 4-hour time frame, which I can manage a bit easily. But some trade 1-hour time frame, some even trade 15-minute time frame. Okay, there are crazy people that trade the 1 minute time frame. So yeah, if you have something else to do on the side, like a job, or you are busy during the day, it's not worthwhile to use lower time frames that are lower than the 1 day or the daily time frame. So yes, trend analysis does work, but you need to understand the currency pair that you are trading. Is it a range bound currency pair, or is it a trending currency pair? If you're using a trend following approach, look for currencies that trend. If you're trading range bound currency pairs, then consider using a swing trading, where you trade the resistance and the support level. One thing that I can trade easily with okay, you're welcome, Tobek. One thing that I can trade with a trend following is DXY. So DXY is the US dollar index. That one, it does trend a lot. So that is how remember, I have an eToro account. Also, I invest in the US using the Ease Equities USD account. So I look at the DXY chart, then I see where I expect the South African rand US dollar exchange rate, USDs are. So then I can say that, okay, maybe the exchange rate is going to drop to 14 rand. Then I decide not to exchange my rands to USD, or maybe the exchange rate is going up. Now the rand is becoming weaker. It means I need to buy a lot of dollars now. So yeah, that's a bit easier to follow. Even the USDs are trading pair. I think that one, it trends most of the time. We haven't really had a time where it was range bound for a long time, right? Let's see. Okay, now I'm done answering that question. I'm just trying to think what else that we're talking about. Yeah, but I just said that it's important that you protect your capital, and also you protect your emotional capital, so that you are not afraid of the stock market. So next week, what's going to happen in the market? Nobody knows. We can't predict. But in the US, I have some positions in energy stocks like Occidental, ExxonMobil. Most of the companies that are involved in oil, we spoke about the price of Brent crude. That one was on an uptrend. It traded above $87 per barrel. So we expect that to continue to move high, probably reach 100 to 120 US dollars per barrel. If it does that, then we can expect the energy companies to continue to do well. Locally, I am bullish on Sasol. I bought more Sasol last week, and then I bought Anglo. Some of the miners are performing well as well so far. So if they continue to perform well, I might add more positions in the mining stocks. I do have Sibanye Stillwater in my portfolio, but it's not part of the dividend portfolio. If Sibanye continues to trade well, let me see at this moment, because there is that previous high. I just want to check. If it breaks above that previous high, then it will mean that it's continuing to trade high. So the highest that it traded was around 75 rand 10 cent. I have a swing trade that I got in at around 55 rand per share, with the stop loss at 50 rand 41 cent. I'm targeting the previous high of 75 rand. So if Sibanye Stillwater breaks above 75 rand, it will mean that it is on an uptrend. I know that the stock pays dividend. Last year they paid a special dividend of 12 rand per share. So I might promote Sibanye Stillwater from a trading position to an investing position. I do have, I try to classify my trades as trading positions or investing positions, depending on whether that company pays dividend or they don't pay dividend, and also if the share price is on an uptrend. If something is moving sideways, it's definitely going to be a trading position, because I could be trading, just taking a position from a support, targeting the resistance, or trading a pullback to the moving average, targeting the recent high, swing high there. Right, so if you go to the description of any of our videos, this one I'm still going to edit it a bit and add some links. You will see that there's an option to join a weekly newsletter. That newsletter is coming from Gumroad. We use a Gumroad to publish that newsletter. So if you want to receive that free newsletter from us, you can sign up there on Gumroad. But remember, we're also selling ebooks that can tell you exactly how is trading the stock market. Each ebook costs $25. We have two ebooks. One is called the Dividend Manifesto. When we speak of the dividend investing, we derive that information from that book. The other book is Systematic Trend Following. When we are trading in general, that is where the rules that we are using. The rules have worked well for us. You saw in the video how much money we made in the stock market. In 6 months, we made 58%. Even though we are saying so ourselves, we know that that was a good performance. We also have a private Telegram account. I will never respond to anyone anywhere when people say, can you create a WhatsApp group so we can talk stocks? We don't talk stocks, we trade stocks. So we have a private member Telegram group, which you can also join using Gumroad. That one will cost you $10 per month. In that group, we discuss stocks, we share trading opportunities, what are we buying, what do we see in the market. So those are some of the things that you can pay for so that you can have exclusive access to some of the things that we do. But remember, this is our YouTube channel. We share trade ideas. So we do share some of those trade ideas with you. We respond to some of your questions and requests using chart analysis so that to make sure that we are able to assist you. The goal will never change, is to assist more and more people to understand trading and investing, and to ensure that people they trade companies high probability setups. I mean, we always get feedback from different people. There is a lady there on Twitter. She said every time on our channel when we say we are buying a company, that means for her she's also buying that company because she watched our videos. She took some of the trades that we were taking and she was profitable. But don't get it wrong, we're not saying that we are always right. We're not even trying to be right. We're just looking for high probability setup, and then we set a stop loss because we can't predict where the market is going to go. So we're not giving you an impression that we are right in the market. We are wrong most of the time, and whenever we are wrong, we try to reduce the amount of money that we lose in the market. Right, I see now there are no more questions that are coming, so I think we're gonna wrap it up here. The video is going to stay on YouTube forever. If you have questions, you can just ask your questions here. You can ask now before we wrap it up, but you can also write your questions in the comment sections. Then we'll be able to answer all your questions there. So if you haven't subscribed, don't forget to subscribe. If you enjoyed this live session, please consider liking this video. We'll try to have these live sessions on most Sundays, not always. We can also be busy. And it's not, we've got lives to live. But whenever you see on Sundays, if you are free, you can just check if there is a session that is going on. We don't want to say that we will schedule it upfront. Remember, it's life. You plan to do something, then life happens. You have to attend to other things. But as long as we are available on Sundays, we will try to have these sessions. So always prepare your questions so that you can ask as many questions as you want. But you can also find us on Facebook, Trend Trader. That's the name of the Facebook. It's a page, it's a profile, it's just a Trend Trader. You can find us on Twitter, Trend Trader JSE. In fact, if you look at our YouTube profile there at the top, we've got links that will take you to our social media. But we are also there on TikTok. TikTok is an interesting place. We are there on TikTok, but the username on TikTok is not Trend Trade. The username is Zwide Kalanga with an underscore, one underscore. There's an amateur there that is trying to replicate our profile. So they've just been playing around with our usernames, stealing some of our videos, uploading them as ours. But remember, TikTok is smart. If I upload a video, on my side, it's clear it does not have my username. On your side as well, when you watch it, it does not have my username. But if somebody tries to re-upload that video, then it will show my username to show that it's a re-upload. So on TikTok or anywhere in social media space, I will never inbox you. especially to ask you for money. I don't have money, but I will never inbox you and ask you for your money. There are people who inbox me on social media to, if they have questions, they ask their questions, I answer their questions. If somebody asks for a one-on-one consultation, then I tell them that I'm going to charge them. Or if somebody say they want more information, then I can tell them that they can check my ebooks on Gumroad. That's the platform that I'm using to sell my ebooks. So you won't even pay me directly, you will pay on Gumroad, you see. So I will never inbox you on social media and offer to help you. It takes time, trust me. We've had classes in 2021. It takes time to have a one-on-one session. It's yeah, it just takes time. I know people pay for it and we appreciate it, so I will never ask you to join that. So if anyone, they come, they represent themselves as me, it's just not me. I'm not the guy that will ask you for money, right? So if you enjoyed this, do like it. We will see you in the next session. Remember, yesterday we uploaded a video. We were talking about how we exchanged our redefined shares for Anglo-American shares. Go watch that video and see why we made that decision and what are we expecting to get from Anglo-American. So that's our recent video there. Thank you. I will see you next week on the next live session.